Hey, my name's Cade Bekanich, certified financial planner and owner of Park Lane Financial Group. And today we're going to discuss why tax loss harvesting may or may not be appropriate for your investment strategies. Let's get into it. Tax loss harvesting is a way to use losses on certain stocks or mutual funds to offset gains when you sell both equities that have gains and losses in order to minimize taxes. Put it this way. If you own Apple at, let's say, $100 a share and it's trading at $120 a share, and you bought Coca-Cola at $100 a share, and now it's trading at $80 a share. If you have an equal dollar amount in each of those positions, and you want to liquidate both of those positions and get your cash back, this is a great way to take advantage of the upside in your Apple position and offset those gains by subtracting the loss from your Coca-Cola position. For example, if you have $1,000 in Apple and $1,000 in Coca-Cola, your Apple position is now worth $1,200 at a 20% gain. If you are down to 80% of your value in Coca-Cola, so $800, you still have $2,000 of liquid securities that can be sold simultaneously to offset the gain and loss of both of those positions. In other words, tax loss harvesting is a great strategy to clear up some cash while taking advantage of losses in certain positions.
How might this strategy change for someone nearing retirement versus someone in their 40s still accumulating wealth?
This strategy varies across time frames. Number one, you have to realize that tax loss harvesting isn't something that can be taken advantage of in a retirement account. Investments in IRAs, 401ks, and other like accounts can be traded as much as you possibly want without incurring any tax liability until you actually take money out of the account. So when operating in a taxable brokerage account, one that's after-tax money, it's important to know how long you've actually held a certain position. There are different types of gains, one being short-term capital gains, the other being long-term capital gains. Short-term capital gains are gains earned on a security held less than 365 days. Long-term capital gains, which are for securities held more than 365 days, or a year and a day, are taxed at a much more favorable rate. This is important to remember when considering what securities to buy and sell and how to take advantage of tax loss harvesting. And remember, I'm not a tax professional, so any of these strategies that we discuss, please make sure you consult with your tax and financial advisor before implementing any of them. I have a personal story that I could share with you about tax loss harvesting and how it actually works. I have a taxable brokerage account, meaning a non-retirement investment account that had gains in those securities. I also had a few positions in that account that had a loss. So in order for me to take out the $3,000 that I needed, I was actually able to sell assets that had both a gain and assets that had a loss in order to completely avoid any tax liability that would come with those sales. In other words, I was able to get the $3,000 that I needed out of my account by selling stocks that were sold at a gain and stocks that were sold at a loss to completely eliminate any tax responsibility. And of course, as always, every situation truly is different. So it depends on your personal circumstances, the type of assets you own, how long you've owned them, and how much money you actually need and when. There are a lot of different things to take into consideration when determining whether or not a tax loss harvesting opportunity is right for you. But understanding that you could take advantage of both securities that have gains and losses when liquidating accounts is a major way to save money. It's not always about what you invest in or what the rate of return on your investment is, but how you take advantage of financial planning techniques that truly allow you to maximize your wealth. From tax planning to estate planning and traditional investment advisory, Park Lane Financial Group is always ready to be your partner in financial planning. Tax loss harvesting has been around for decades, and truthfully, I think it's an underutilized tool by a lot of financial planners that really want to help their clients but just don't know how. So don't forget, the next time you need to take money out of an investment account, don't be afraid to take a step back, look at your account, consult your CPA or your financial planner, and ask them how you might be able to take advantage of some of the gains and losses held in that account in order to get the money out that you need and minimize your tax liability as much as possible. It's a great way to save money, an amazing way to save in taxes, and it's an opportunity for you to have a more hands-on approach with managing your money. So whether you have a position with $1 million gain or a position with a $100,000 loss, this is an amazing strategy that might be able to help you save on taxes. I've got plenty of other videos covering different financial planning topics, from retirement planning, estate planning, tax minimization strategies, and so much more. So don't forget to check those videos out. I appreciate you guys watching. We'll see you in the next one.